You never filed this. You've qualified for years.
Nobody told me that existed.
9.3 million American seniors qualify for a property tax break right now. Only 8% of them ever file for it, which means more than 9 million people who have earned this, who own their homes, who meet every requirement, are paying a bill they don't legally owe year after year because they never signed one piece of paper. This isn't a scam text. It isn't a rumor going around a Facebook group. It's a real form sitting in a real county office, and the office that mails you your tax bill has no obligation to mail you the form that lowers it. They calculate what you owe. They don't calculate what you're allowed to skip. That part is on you to ask for. And almost nobody does. Here's what makes it worse. In most states, these programs aren't retroactive. You have to file in the year you first qualify. Miss that window, and that year's savings are gone. Not delayed, not owed to you later, just gone. So every year, those 9 million people wait, thinking someone will tell them, is a year of money they never get back. There are 8 different ways this shows up, depending on where you live and who you are. 8 separate forms, each one releasing money the law already says is yours. And by the end of this, you'll know exactly which ones to walk into your assessor's office and ask for by name. 2 assumptions make people scroll right past this, and both of them cost money. The first is that property tax breaks are for struggling seniors, so if your home's paid off and you're comfortable, you tune out. In Texas, the biggest senior benefit in the state has no income test at all. A paid-off house and a healthy retirement account qualify you for the exact same break as someone living on Social Security. Comfort doesn't disqualify you. It just makes you more likely to leave the money sitting there. The second is quieter and costs more. I filed my homestead exemption years ago. I'm covered. In almost every state, the senior break is a separate form from the one you filed when you bought the house. Filing once, decades ago, doesn't sign you up for the over 65 benefit. That's a different piece of paper. And it's the one most people never file. So, wherever you live and whatever you've saved, stay with me and type your state in the comments as we go. Way 1. The General Homestead Exemption. Start with the one you probably already have because you need it to understand the 7 that follow. The General Homestead Exemption knocks a flat dollar amount off your home's taxable value before the tax rate is ever applied. You're not taxed on what your house is worth. You're taxed on what's left after the exemption comes off. In Texas, that General Homestead Exemption is $140,000 off your home's value for school district taxes, and school taxes are the largest slice of a Texas property tax bill. So if your home is appraised at $300,000, the school district doesn't tax you on $300,000. It taxes you on $160,000. That's the baseline every homeowner gets just for living in the house as their primary residence. Here's why I'm starting here instead of skipping to the senior stuff. This exemption is the floor. It's the one most people did file, usually right after they bought the place, and then never thought about again. And because they filed this one, they assume they're getting everything they're entitled to. They think the box is checked. It isn't. This is the break every homeowner gets at any age, the senior benefit. The one with your name on it the day you turn 65 is a completely separate exemption that stacks on top of this one. Same form, different section, and if you filed before you turned 65, you never filled that section out. So this first one isn't the payoff. It's the setup. It's the reason 9 million people believe they're covered when they're leaving the biggest number on the table. That number is next. Quick note before we go further. I'm not a lawyer or a tax advisor, and this isn't personal advice. It's the briefing that helps you walk into that office already knowing what to ask for. Way 2, the senior add-on. Here it is. The day you turn 65, Texas gives you another $60,000 off your home's value for school taxes, on top of the $140,000 everyone already gets. Stack them together, and that's $200,000 of your home's value the school district can't touch. Let me put a real number on it, because this is the one the title promised you. The Texas Comptroller, the state's own tax office, estimates that this senior exemption saves the average qualifying senior about $1,933 a year. Not a projection from some blog. The state's own figure. Walk that forward. $1,933 a year across a 20-year retirement is $38,660. That's a car. That's a year of a grandchild's college. That's real money. And for the seniors who never filed the over 65 section of that form, it's money the school district quietly kept, legally, because no one made them give it back. Now, that specific dollar figure is Texas. Your state's number will be different, and I'll show you states where the mechanism works in completely different ways in a minute. But the pattern holds almost everywhere. There's a general homestead break, and then there's a separate senior break stacked on top of it, and the senior one is the one people miss. In Texas, the form is called the 5114, and you file it with your county appraisal district. You mark the over 65 option. That's the box people skip. And here's the part that makes Texas unusually forgiving. If you already turned 65 and didn't file, Texas lets you claim it retroactively, up to 2 years back. Most states do not do that. In most places, the year you miss is the year you lose. So if you're past 65 and you've never filed the senior section, that's the phone call to make this week. If you know someone with a paid-off house who turned 65 and never touched their exemption since, send them this. That's a 2-year, $38,000 favor. And tell me in the comments, did you know the senior break was a separate filing? Way 3, the tax ceiling. Everything so far has been about shrinking the value they tax. This next one is different. It freezes the bill itself. When you turn 65 in Texas and file that same over 65 exemption, something else switches on automatically. A school tax ceiling. From that year forward, the dollar amount of school tax you pay is locked at whatever it was the year you turned 65. Your home can keep climbing in value, and in a lot of Texas neighborhoods, values have jumped 40, 50% in 5 years. But the school portion of your bill does not move. It's frozen at the 65 number. Think about what that means over a retirement. Most people accept rising property taxes as a fact of getting older. The house is worth more every year, so the bill climbs every year, and you just brace for it. For a senior who filed, that's not true anymore. The market can do whatever it wants. The school tax bill stays put. 10 years from now, you're paying the same school tax you paid the day you qualified, while your neighbor who's 64 is absorbing every increase. And it travels with you. If you sell and buy another primary home inside Texas, that ceiling percentage transfers to the new house. You don't lose the freeze by moving. There's one honest limit here, and I'll always give you the limit. The ceiling covers the school district portion, the biggest piece of most Texas bills, but not the whole bill. City and county taxes can work differently. So the freeze is powerful. It's just not the entire tax bill going flat. Sharp is better than exaggerated. This is where the states start to diverge, though. Texas freezes the bill. The next state I'll show you freezes something else entirely, the value. And the difference between those two decides whether your bill actually stops moving or just slows down. If your state has a senior freeze, you need to know which kind it is. Tell me in the comments what state you're in, and I'll point you at the right one. Way 4, the income-based freeze. Illinois has a senior freeze too, and this is where people get burned by assuming all freezes are the same. Illinois doesn't freeze your bill. It freezes your home's assessed value, the number they start the calculation from. And those are not the same thing. Here's the difference in plain terms. In Texas, the bill is locked, so the dollar amount stops. In Illinois, the value is locked, but the tax rate is still free to move. So if your town raises its rate, your bill can still go up, even with the freeze on. The freeze slows the bleeding. It doesn't stop it cold the way the Texas ceiling does. That's not a knock on Illinois. It's just what freeze actually means there, and if you walk in expecting a flat bill and get a slower rising one, that's the gap between what you assumed and what the law says. Illinois calls it the Low-Income Senior Citizens Assessment Freeze, and the name matters because unlike the Texas benefit, this one has an income limit, and that limit is climbing fast. For the 2025 tax year, it was $65,000 of household income. A new state law bumped it to $75,000 for 2026. Then it steps up to $77,000 in 2027 and $79,000 in 2028. Why does the climbing limit matter to you? Because a lot of seniors checked once, years ago, saw they were a few $1,000s over the cutoff, and crossed it off their list forever. That cutoff has been moving up every single year. If you were just barely over it in the past, you may be under it now, and you'd never know unless you looked again. This is a program worth rechecking annually, not once. One more thing that trips people up. You have to reapply every year. It doesn't roll over on its own. Miss the annual filing and the freeze lapses. So if you're in Illinois or a state with an income-based freeze, put the application on the same calendar as your taxes. Comment Illinois if that's you, and I'll make sure you've got the right form name. Way 5. The form you never filed. New York's double stack. New York is where the title of this video comes true, because New York runs 2 separate senior programs at the same time. And filing for one does not sign you up for the other. 2 forms, 2 offices, 2 savings. And most seniors file one, assume it covered them, and leave the second sitting untouched. The first is Enhanced Star. If you're 65 or older in New York and your income is under $110,750, Enhanced Star cuts the school tax portion of your bill. Fine. A lot of people have that one. The second is the one people miss. It's called CK, the Senior Citizen Homeowners Exemption, and it can knock up to 50% off your home's assessed value. Half. That's not a trim. That's the single biggest percentage cut on this entire list. And here's the trap. CHE is run by a different office than Star. In New York City, SCHE goes through the Department of Finance. Star goes through the state. Applying for one does nothing for the other. So a senior who registered for Star years ago genuinely believes they've claimed their senior break, and the 50% one is still sitting there unfiled, saving them nothing. Think back to how this video started. 9 million people, a form sitting in an office, no one mailing it to them. This is exactly that form. It's real, it can cut your assessed value in half, and the only reason you don't have it is that no one connected the 2 programs for you. Now, the exact dollar figure depends on your income and your locality. SCHE runs on a sliding scale, and the deeper under the income cap you are, the closer to the full 50% you get. So I can't hand you one number the way I could in Texas, but I can tell you the move. If you're a New York senior, you need both, Star and SCHE. If you've only ever filed one, you're the person this whole video is about. Comment New York, and I'll make sure you know which office to call for the one you're missing. Way 6. The rebate that pays you back, New Jersey. Everything so far lowers what you owe before the bill is calculated. New Jersey does something different. It lets the bill come in full, then pays you back a chunk of it. It's called Stay NJ, and for eligible seniors, it reimburses 50% of your property tax bill, up to $6,500 a year. $6,500 back in your pocket on a bill you already paid. In a state with some of the highest property taxes in the country, that's not a rounding error. That's a mortgage payment or 2. But this one comes with a live warning, and I'm going to give it to you straight, because that's the whole point of this channel. Stay NJ's rules just changed. As of the state budget signed in the summer of 2026, the income cap dropped from $500,000 down to $200,000. And the benefit now scales by income. If your household makes under $100,000, you're looking at the full $6,500. Between $100,000 and $150,000, it steps down to $5,000. Between $150,000 and $200,000, $4,000. Above $200,000, you're out. Those are the numbers as the budget stands right now. And here's why I'm flagging it harder than the others. This is a brand new program that's already been rewritten once, midstream. So if you're in New Jersey, do not take my figures as frozen. Check this year's threshold before you count on the money, because it's exactly the kind of program a future budget adjusts again. That's not me hedging. That's the honest state of a benefit that's still settling. The through line, though, is the same as every other state on this list. It doesn't come to you. New Jersey seniors file a single application for Stay NJ, along with the state's other relief programs, and if you don't file it, the reimbursement simply never arrives. Comment New Jersey if that's home, and I'll point you to the combined form. And if any of this is running long, trust me, The biggest single number on the whole list is still coming, and it isn't a discount. It's the entire bill gone. Way 7. The entire bill gone. Disabled veterans. If you're a veteran with a 100% permanent and total disability rating, there are 22 states where you pay zero property tax on your home. Not a discount, not a percentage off. Zero. The entire bill, erased every year, for as long as you own and live in the home. Texas is one of them. Florida, Virginia, Maryland, Illinois, and about 17 others. On a home with a $3,000 tax bill, that's $3,000 a year, $30,000 over a decade. On a higher value home in a high tax state, veterans save $7,000, $8,000, $10,000 a year. This is, by a wide margin, the largest single break on this entire list. And it's the one most likely to go unclaimed, for a reason that has nothing to do with income or paperwork. Veterans assume it's automatic. You've got a rating from the VA. The VA already sends your disability compensation every month, so it feels like the property tax break should just follow. It doesn't. Your VA disability rating and your property tax exemption are two completely separate systems. The county assessor does not talk to the VA. Nobody at the VA files this for you. It's a separate application at your county or state tax office, and you have to bring your rating letter and start it yourself. That's the disconnect that costs veterans the most. The benefit is enormous, the eligibility is clear-cut, and the only thing standing between a qualifying veteran and a $0 tax bill is a form nobody told them to file. At an office they had no reason to think was involved. The rules vary by state. Some drop the full exemption in at 100%, others start partial exemptions at lower ratings, and surviving spouses often keep the benefit. So the exact terms depend on where you live. But if you or someone in your family is a disabled veteran, this is the single highest value phone call in this whole video. Make it. And if you know a veteran with a paid-off house, share this with them directly. This one break could be worth more than everything else on this list combined. Tell me in the comments if you had any idea this was separate from the VA. Way 8, the one that isn't a discount, deferral. The 8th one is different from the other 7, and I want to be honest about how. It doesn't lower your bill. It doesn't freeze it or refund it. It lets you postpone it. It's called a property tax deferral, and states like Oregon, Minnesota, Massachusetts, Texas, and California offer some version of it. Here's how it works. If you qualify, you can put off paying your property taxes, sometimes indefinitely, and the unpaid amount becomes a lien on the house. It gets paid back later, out of the proceeds when the home is eventually sold, or from the estate after you pass. So this isn't free money, and I won't dress it up as if it is. Every dollar you defer is a dollar less that your heirs inherit. What it buys you is breathing room, right now when you might need it most. Picture the senior this is built for. House is paid off, fixed income. Cash is tight month to month, but the home is worth a fortune on paper. House rich, cash poor, as the saying goes. For that person, a deferral can be the difference between staying in the home and being taxed out of it. California, for instance, offers postponement to qualifying seniors at a set interest rate. Texas lets homeowners over 65 defer indefinitely. The terms vary, the interest varies, and that trade-off, cash flow now against inheritance later, is a real one you should walk through with your family, not alone. I put this 8th on purpose, not because it's the smallest, but because it's the one you have to think hardest about. The first 7 are close to pure upside. File the form, keep the money. This one is a genuine decision. But for the right household, it's the one that keeps them in the house, and that's worth more than any single line on a tax bill. 8 ways, 8 separate forms, and not one of them arrives in your mailbox on its own. That's the thread running through every single one. The Homestead stack in Texas, the tax ceiling, the income-based freeze in Illinois, the double program in New York, the New Jersey rebate, the veterans' $0 bill, the deferral. Every one of them is money the law already says you can keep. And every one of them sits there, unclaimed, until you walk into an office and ask for it by name. The system that mails you the bill has no job that involves lowering it. That job is yours. Remember the number we started with: 9 million seniors eligible and only 8% filing. For the average Texas senior, that unfiled form is $1,933 a year, nearly $39,000 across a retirement. In New York, it might be half your assessed value. For a disabled veteran, it could be the entire bill. Different states, different forms, same truth. The money's already yours, and the only thing between you and it is paperwork nobody handed you. So here's what to do this week. Go to your county assessor's website or your state's Department of Revenue and search 2 words: senior exemption. See what your state offers. Then call the office and ask them directly, what property tax relief do I qualify for as a homeowner over 65, and what's the deadline to file? That one phone call is the whole game. If the answer's confusing, a tax professional can walk you through it. And given what's at stake, that's money well spent. One last thing, and then I'll let you go. Somebody watching this has a parent or a neighbor or an old friend with a paid-off house who's been quietly overpaying for years because no one ever told them any of this. Send it to them. That's the entire reason to make a video like this. And drop your state in the comments. Tell me which of these 8 you didn't know about, and I'll tell you where your version lives.